Good morning, Richard Calhoun, Creekside Realty. We're here to discuss the real estate market in Silicon Valley, graphically and geographically, plus the greater Bay Area, which includes 13 counties. We'll come back to the slide at 58 and do discussions. This is a new slide that I added in this week, and what it's trying to do is explain why there's a price reduction at the end of every year. And I think this slide actually documents it. When I first started doing the statistics, I assumed it was because smaller homes sold, and that really wasn't the indication based on square footage. So now what I'm doing is I'm looking at the affordable, the blue line, the percent of the market share compared to the expensive area. The expensive areas are here. The market share of expensive areas goes down at the end of every year, and the percentage of market share of the expensive areas goes up at the end of every year. Therefore, the median price would go down even if the property values didn't shift, because you're selling fewer expensive homes and more inexpensive homes. That drops your median price. So this in itself probably explains why the prices drop at the end of the year and market values could be unchanged. What this really tells you, it's really important to focus in not on what's happening in the Bay Area, not what's happening in the county, but what's going on in the micro market that you're looking in. Because of the micro market you're looking in, even if a few less expensive homes sell and a few more inexpensive homes sell, that really doesn't have much impact on the median price. So what this does is it basically drives home the point that it's important to look at the data very local to the property you're looking at. This is the ratio versus the sale price. So here I took the market share of the expensive homes compared to the market share of the inexpensive homes and did a ratio. The expensive homes are becoming a smaller percent every time the blue line drops down, and then the orange line is the median sold price. There's an exception right here, so there are some exceptions, but the end of the year dip is basically shown in all the cases. Now here you have a dip in the market share, but no dip in the median sold price. And that's because the median sold price was actually going up fairly steeply at that time. So you sort of have this U-shaped trough. I think that does a fairly good job of identifying why the prices dropped at the end of the year. This is looking at days unsold inventory, the key indicator for the marketplace. I consider anything from 42.5 to 77.5 to be a balanced marketplace. Saturated red at 7. You can see a lot of these days are 20 and below. There's a few more, and there's a few real standout exceptions, like the expensive areas in San Mateo County, 144 days, and Foster City Redwood Shores, which is a real small area at 131 days. And we'll come back to this because we'll see it somewhere else where it appears that the reason, and I didn't dive into the detail, but my best guess is there's probably been a flood of new listings coming on the market that haven't had an opportunity to sell because the days on market is still fairly reasonable for Foster City Redwood Shores. But in any case, very small market share, a lot of statistical fluctuations, pointing it out all the time just because it is such a small area. Here is days of unsold inventory over time. You can see that last year we were pretty pale, then we got deeper red, and we're still pretty deep red over here. Most of the areas are red. White is a balanced marketplace. Blue is more of a buyer's marketplace. This is the 75th percentile, and this is actually the slide that I was talking about. And sorry, I did not update it. You'll see that on the San Mateo County coast, it's blue on the map and white on the index over here. I caught that error and changed it everywhere except in the index. At least I think I changed it everywhere except in the index. This should be blue over here as it is on the map. But if you look down here at Redwood Shores, the 75% of the sellers are selling within 10 days, which does not make a lot of sense with the DUI being so high. But if all of a sudden you had a significant percentage of the market just came on, say this last week, that would give you a lot of inventory compared to the number of sales, and those homes haven't had an opportunity to sell yet. And I think that's exactly what's happened. Look at these numbers. Overall, you can see that there are 2 weeks or less, more or less, for a good number of the areas. And that's saying that 75% of the homes are selling, 75% of the sellers are selling their home within 2 weeks of going on the marketplace, which by anybody's definition is a fast marketplace. And in fact, you don't see any area over 45, because if you were over 45, except for the coast, they would be blue in color, and everything on there is a shade of pink. Now we're looking at the asking price reductions This is how much the sellers are reducing their price before. You can see San Mateo County is doing a lot more price reductions than the more affordable areas in Santa Clara County and over in Alameda County. It's sort of surprising on how red that graph is, but part of the problem is this is a sensitive thing. Once you get up near 100%, sellers don't take much of a price reduction. I'm only red from 99 to 100% because you're not going to see this go over 100%. Sellers aren't going to, on average, be raising their price. There might be a few sellers that raise their price, but on average, it would never go up. Here's the overbid magnitudes. This is where you take the sale price to list price. So now you're having a lagging indicator because you have to wait for escrows to close. Same concept, the redder the color, the hotter the marketplace is, and you can see that the north areas of Alameda County are the hottest areas, being Oakland, Berkeley, and Alameda. And then you have basically a pale red for the bulk of the area. You have the expensive areas in Atherton that are seeing a 2% reduction when the offers come in. This is the frequency of overbidding. How common is overbidding? The lowest areas, again, the expensive areas in San Mateo County, where only 25% of the sellers are getting more than their asking price. The bulk of and the west portion of Santa Clara County is sort of in a balanced marketplace, which is between 33 and 50% of the sellers getting more than their asking price. Alameda County and Santa Clara County are pretty much in a seller's marketplace with more than 50% of the sellers getting above their asking price. And that is the percentage. So the highest percentage I'm seeing is 75%, except for the city of Alameda and Berkeley down here at 82% and 75% in Oakland, 74% in Fremont. So you can see the East Bay is particularly hot, but most of Santa Clara County is pretty hot too, right around 70 and just under 70% of the sellers getting more than their asking price. This now is looking at the appreciation since the last 9 months of 2015. I used that as a base sort of year. It wasn't a year, but that was when prices were relatively flat and stable. So I thought it was a good period of time to use and representative. You can see that San Mateo County is blue and most of Santa Clara County and Alameda County are pale or red. And what this says is that San Mateo County has not appreciated as much as the other two counties since 2015, and most of that lack of appreciation has happened since the pandemic came along. Here's the sold price in the areas. Instead of just following the median sold price, I follow the 10 percentile, which is the cheapest 10%, as well as the median, which is the 50 percentile in the middle number. And then the number on the right is the most expensive 90 percentile in that given micro market area. Color is assigned by the median price in the middle. And you can see the west area of Santa Clara County is sort of the expensive areas. Redwood City is very close typically to the median price. And I think once I've added in Alameda County, I think it's actually shifted down to Cambrian, Santa Clara, Willow Glen, Campbell as being the median versus Redwood City, which was the median area when I was looking at just Santa Clara County and San Mateo County. Here's a summary of the different indexes we just went over so you can find what your micro market is and what each one of the components is. Here you can see the Redwood Shores, if I can find it right here, 131 days, but 75% of the sellers are selling their home in 10 days. Right on the face of it, that doesn't make any sense at all. But if there's, say, 8 homes on the marketplace and 8 new listings come on the marketplace, you've just doubled your DUI, but they've also lowered the days on market at the same time when those homes sell. My gut feeling is the homes haven't sold. They're probably in their first week on the marketplace. But either pick the area that you're looking in and figure out what the conditions are, or come over here and find out the price range and therefore define what areas you're then going to be looking in and know what the market conditions are going to be. Here we moved on to looking at the ask price reductions. I actually like this chart. It's looking at the amount of the sellers, on average, what the sellers are doing with their ask price. Are they reducing it? Are they increasing it at the time the offer is accepted? The huge advantage of this versus overbidding is you don't have to wait for escrows to close. There's no lag time. The blue line down here is sort of the worst recent week. We did have a week back here which was worse, and I think that was January or something of 2008 after the mortgage meltdown, even though this was the worst line, which was just in December 27th of last year, 5 months ago. The best line we ever had is up here also fairly recently, Valentine's Day of 2022, so just a little over a year ago, and that was basically when everybody was no one was reducing their asking price. So what we're going to do is step down. If the line moves down and to the right, that's a decreasing marketplace. If it's moving up and to the left, that's an improving marketplace. The blue arrow indicates a down market, a red arrow indicates an up market. When they're both there, it's a plateau. This is shaded because it's really shouldn't be there because the market's actually going down at this time, but I wanted to show the red arrow. So stepping through, you can see the decrease 10 months ago, 9 months ago. And when we hit 3 months, we shift over to go weekly. So now you see a little fluctuation there, a little plateau going down. Now you have an extended run up that's in the last 12 weeks. And now the last several, even though I still have it up, it's pretty close to a plateau. You can see that there isn't much movement and it goes up and down a little bit. So what that basically says is when we got into the beginning part of this year, somewhere around 12 weeks ago, the market improved steadily. And right now the market's sort of at the peak probably for the year. And I believe one of the first indicators that we will see that the market's turning is this ask price reduction starts increasing, which would mean it's going down and to the right. Now we're going to shift over to the sold price. So you now are introducing the escrow delay, and this is the sale price to list price overbid. So this is how much buyers are overbidding at the time the offers come in. The concept is the same as the last slide, but here the best week we ever had was March 29th, 2022. It varies a little bit. If you added in Contra Costa County, it jumps up to something like April 14th. So each county again has a little different cycle. The worst week we really ever had was back here November 30th of 2001, right after the World Trade Center. And we'll step through. So you can see it coming down. A little bit of a plateau. And now it's going to start marching up again. And even the overbidding is sort of getting a little bit of a plateau. At least it's not marching up as much as it was at the beginning part of the year. And again, this is about a 5-week delay. So we'd expect that plateau to be occurring. I'm a little surprised it's showing up so quickly. Here we have my base URL in the green. That basically is your key to do things with this market data information. You add in 2023 to the base URL and you get to the live presentation Saturday morning at 9 a.m. You add in the letter H, the year 2023, the month 04, the day 22, and all is one word, and you get the handout. 55 pages, 56 pages, the key slides of this 101 slide presentation. If you want to see a specific episode on YouTube, you put in the green URL plus the year, month, date code. The green URL itself takes you to the YouTube channel. And I'm Richard Calhoun with Creekside Realty, working with buyers and sellers in the Silicon Valley area. And do I have anyone with a question? Not seeing any questions. Going forward, you can interrupt at any time. Okay, here is a slide showing Silicon Valley. The 3 thin lines, the blue is the 10 years worth of data for that particular week. It's looking at the lowest 10 percentiles that favors the buyer. The gray line is the median. That's where you'd expect the market to be if you're having an absolute typical year based on the last 10. And the red line is the top 10% favoring the seller. The purple line is where we actually were. So very quickly, you can see that the latter part of 2021 was very much favoring the sellers. Then all of a sudden you get into this period of time in 2022 when we flipped over from favoring the sellers to a typical year. And now we're in 2023 and we're favoring the sellers again. And this is based on inventory. So what that says is you have very little inventory. And to give you some idea, you're down here close, just over 1,500, call it 1,550 listings, where you'd expect to be up here at about 2,450. So we're short by about 900 listings out of 2,500. That's a fairly significant shortage. It's a shortage of about a third of your inventory. So we only have 2/3 of the inventory that you would expect to have, and that favors the sellers. But now if you look at the flip side and you look at the number of offers, your offers are down here somewhere around 1,800, call it, and you'd expect offers to be up here almost at 2,800. So now you're missing 1,000 offers, again, about a third of the number of offers. But the lack of offers favors favors the buyer. And that's why it's important to look at the ratio, because that's the real key. And that's what this is doing. It's looking at the ratio between the number of buyers you have and the number of sellers you have. A hot marketplace would be down here with only 20 days of unsold inventory. A typical would be right here at 30 days. And that's where we are. We have a shortage of offers, but we also have an equal shortage of sellers, which puts us so that the ratio between the two is exactly where you'd expect the market to be. So the market's moving as quickly as you'd expect it to be for Silicon Valley, but there's just not as many transactions going on. And the worst you'd expect it to be is up here around 43 days, 42 days of unsold inventory. The speed of the market is completely typical. The robustness of the marketplace is what's lacking. Now we're looking at the number that I'm starting to like quite a bit, the 75th percentile. This is 75% of the sellers are selling their home in this amount of time or less. So in a hot marketplace in Silicon Valley, it's about 12 days, it looks like, maybe 13 days. It takes 13 days, basically 2 weeks for 75% of the sellers to sell their home. In a typical marketplace, it's up here somewhere maybe around 16, 17 days to sell 75% of the homes. We're right here at about 18 days, and the coolest we've ever been is 20. So it's pretty compact going from 20 to, something like 16 days down to 12. But again, it gives you just another benchmark on, what the speed of the marketplace is. This is the largest 10%. What percentage are the sellers that are taking the biggest reductions is that? And right now you can see that 10% of the sellers are taking somewhere around an 11% discount, because here's your 89 percentile right here. So they're just about 88.5%. So that means the sellers are taking 11.5% discount. That's not from when the offer comes in. That's the sellers reducing their own price. So sellers are reducing their price. 10% of the sellers are reducing their price 11.5%. And you might think, well, 11.5% reduction isn't that much, and 10% of the sellers is a pretty small segment. And that is true. And the reason I'm looking at this benchmark is a lot of times, if I look at any greater percentile, like the 25th percentile, it's at 100%. So it gives you no indication at all. A cool marketplace, though, is at 90%. So where sellers are taking a little bit bigger price reductions than they have been in the past. And that's the past 10 years. Where you'd expect it to be is 93%. So typically, if you're having a normal year, you'd only have a 7% reduction. And the best year we ever had is up here at basically 6.5%. So there's not much difference between our best year and what a typical year is. But the fact is, right now, we're basically taking some of the biggest price reductions. So even though the market's moving quickly, it would be an indication that some sellers still have this mindset that their home is what it was worth at the peak of the 2022 marketplace, and it simply is not. Here's looking at the list price at the time the offer is accepted, average. So now we shifted from that 10 percentile to show you what the number is to average. And you can see on average, you're somewhere around 99.25%. And again, that may sound pretty good, but you can see it's the coolest marketplace. The typical's up here about 99.75, and our robust is about 99.9%. So very small price reductions typically in Silicon Valley. Price is very important in selling real estate in the local marketplace. The frequency of price reductions, this is how common are price reductions. The worst year we've ever had has been about 13%, and that's basically exactly where Silicon Valley is right now. The typical number of sellers doing any sort of price reductions down here somewhere around 8 days, and in a hot marketplace, it's only 6% of the sellers that are doing any price reduction whatsoever at this time of the year. This is the median overbidding. So now we're flipping over and looking at what offers come in. The 50% of the buyers are paying 2% or more above asking price. 50% of the buyers are paying 2% or less over the asking price, which would also be under. So if someone's offering 99%, they're in the 2% that's offering less than 2% above. You'd expect it to be at 4%, so it's half of where you'd expect it to be. The highest we ever were is about 111%, maybe 110.5%. This now is the average overbid. So the average is going to be higher than the median when there's no upper limit. So when you put everything in a blender and mix it up, right now the average overbid is somewhere around 105.5%. The typical is somewhere around, and that's exactly where it would be in the worst years. The typical would be somewhere around 106.5%, and our best year is up here at 112.5%. Frequency of overbidding, how common is overbidding? You can see right now it's down here, which is corresponding to the coolest marketplace, is less than 65%, which, almost sounds weird to say the coolest marketplace we've ever had is 65% of the sellers are getting more than their asking price. But at this time of the year, it is, because typically what happens is prices go up at this time of the year, so sellers are typically lagging behind. Part of the reason when sellers are doing price reduction is a year ago prices were higher, which is a fairly uncommon occurrence. The typical frequency of overbidding is almost 75%, and the best we ever were was up here around 84%. Pretty robust overbidding typically in Silicon Valley. Here is the sold price on log scale. I think what's education on this, you can see the end of the year dip that we sort of explained away, but when the blue line is below the thin sloped blue line, straight blue line, there's upward pressure on price. When the data line, the purple line, is above, there's downward pressure on the price, because the blue line is sort of the long-term equilibrium where you'd expect the market to be. It's just something noteworthy to pay attention to. This is the number of active listings. What we're doing now is we're looking at each of the 3 counties that make up Silicon Valley. So instead of just looking at Silicon Valley as a whole, we're looking at Santa Clara County in the blue, we're looking at San Mateo County in the orange, and we're looking at Alameda County in the gray. You can see Alameda County and Santa Clara County are roughly the same right now. Historically, Alameda County has had more listings than Santa Clara, but now they're the same. The real takeaway is look at the number. We're right here at 600, and if you come back and look at any sort of reasonable number, the first thin vertical line is going to be the first quarter, which is April 1st. So that's pretty close. You're somewhere around 1,200. You're around 1,200. You're around 1,200. Here you're around 900 for Santa Clara County, around 1,200 for Alameda, 1,200 for Alameda, around 1,000. So very quickly you're seeing you're north of 1,000. Then we got into 2020, and boom, that number dropped down to 800. In 2021, that number dropped down to 600. In 2022, that number sort of got up here to about 800. And right now we're down at about 600 again. So the lack of inventory is a new thing that we have dealt with basically for the last 3 years, with this year and 2021 sort of being the worst. Here's the number of offers accepted. Here you can see again the numbers are up around 1,200. I'm not going to go through the whole thing again. And you can see now you're down under 800. So you can see a lack of inventory, or lack of offers. San Mateo County is not as dramatic, 600 down to some number around 350 maybe. Clearly you're seeing the reduction in volume. Here's your days on sold inventory. The big takeaway on this one is if you come back here before the pandemic, San Mateo County was the lowest, which is the fastest paced marketplace. You come into the pandemic, and ever since the pandemic, San Mateo County has been worse or on top of. And now you can start seeing the separation where San Mateo County is slower than either Alameda County or Santa Clara. We've had a shift. Being close to work isn't as important, and that county that was relying on that for their premium prices has slowed down more than the other 2 counties that are benefiting from the pandemic. Here's days on market. San Mateo County is the slowest. Santa Clara County and Alameda County are very similar. It's something like 18 days. And San Mateo County is not particularly slow at something like 22 days, but it's noteworthy that if you look back here, they were all sort of right on top of one another, and boom, we got to the pandemic, and then all of a sudden the orange line was on top, except for in the run up after the pandemic. Now that we're getting past that, San Mateo County is slowing down again. This is the magnitude of list price reductions by the seller. Here is real telling. You have Alameda County and Santa Clara County up here. I tried to make it, you can sort of see the blue on this side of the gray. It's tough when the data is right on top of one another, but now Santa Clara County and Alameda County is right at 100%, which is what you'd expect it to be a lot of the time, and that's the average. And I'm looking at the average intentionally because the median would almost always be at 100%. So I'm trying to get some fluctuation, but you can see that San Mateo County is way down compared to the other 2 counties. The magnitude of overbidding, Alameda County has the most overbidding, and it has basically since the pandemic. Why is that? Alameda County's been further away from the commute center. Livermore, even Union City, Fremont from Silicon Valley is a longer commute. People are going over there, and now it's getting overbid. Santa Clara County in the blue and San Mateo County in the orange are doing relatively well. All of them are doing well in one way. The overbid sitting here at something like 103.5% for these 2 counties, but 108% for Alameda County. So a big standout. This is the frequency of overbidding. Again, Alameda County comes away with 70% of the sellers getting more than their asking price. Santa Clara County is next at about 62%, and San Mateo County is coming up at the end, but still 50% of the sellers are getting higher than their asking price. Here is your median price for each of the counties. Here, you're starting to get a little bit more what's happening to property values because you're looking at a more reduced area, but still in Santa Clara County, which is what I did this shift in. This end of the year spike is not property values, but that shift in the marketplace. And you probably have the same shift in the marketplace happening in San Mateo County and in Alameda County. I just didn't go and look at the expensive areas in those areas versus the inexpensive areas, but I would assume that's what's happening. Here's your median sold price on regular paper. So the previous was on log, which I prefer log because the slope of each one of these lines is your rate of appreciation. So you can now start comparing San Mateo County, and you can see San Mateo County was coming up, and then it's been much flatter since the pandemic. It flattened out like all the areas did, but then the pandemic happened right about here, and it's been, more flat than it has been in the past. I don't know how to say that. Maybe the way to say it is if you bring back the horizontal line, if you come back to before the pandemic, the distance above from same color, so orange to orange, is less than the difference between blue to blue or the difference between gray to gray. And that's what's nice about logarithmic scale is essentially it takes into consideration percentage. So the percent increase is what you're looking at. Here's the median sold price on regular analog paper. Here's the appreciation for the different areas, and you can see that Santa Clara County has had the highest appreciation, followed by Alameda County, with San Mateo County having the least amount of appreciation, and that's again from the last 9 months of 2015. Here's the actual data. If there's some particular data point that you want to look at the drop in the number of new listings across the board. Part of that was last week was an unusually high number because people held their house off for Easter, and that means the week after Easter has more new listings coming on the market than typical. So this will sort of level off, but this is a 5-week number, so that increase is there. So basically it's saying that this last week there was a whole lot less inventory than a whole lot less inventory coming on the marketplace than there was 6 weeks ago that got dropped off. The number of active listings has gone up a little bit, not dramatically, 5% overall. The offers accepted are basically up almost the same percentage, resulting in a fairly stable DUI. And then this is closed data. You can pick up what data point you're looking at. I have 2 appreciation rates, one since 2015 and one since 2020. So since the pandemic, San Mateo County's only gone up 14%, where the other 2 counties have gone up 22 and 26%. So you can see San Mateo County is lagging behind. And then if you look at the appreciation overall, it's lagging behind. And that's because this appreciation pulls down this appreciation. What would have been interesting is if I did an appreciations from 2015 through 2020 and then one subsequent. And then I would think that these would be more similar. Whatever's appreciated the least in the last time period impacts whatever time period you're looking at because of the compounding. This data is a table, not comparing apples and apples, and it's Santa Clara County single-family homes only. It's going back over 25 years. The reason I say it's not comparing apples and apples is the data for past years, 2022 and past, is basically for the month of April. We're not through April yet, so I'm only using the most current data. So I'm comparing data through last night at midnight versus data through April 4th at midnight. But again, there are some takeaways, and the takeaways are the same as what they've been. Volume is on the low side at 603. Number of offers, the only year that's lower was the pandemic. The only year that had fewer number of closings was the pandemic. Now, for those that want to compare apples and apples, you can look back, but now you're looking back at March. This is comparing apples and apples because you're looking at the same data collected at the same time. This is looking at record low volume of offers. You can see that we're now the 24th out of the last 25 years. And the reason for that is the pandemic is the lowest. And the numbers for the pandemic are down here typed in. The reason I did not want them in the chart is I wanted to calculate that if you ignore the pandemic, we're still only selling 70% of the number of offers that you would expect based on the last 25 years. And based on the last 10 years, we're only selling about 63% of the normal. It is pretty significant. This is looking at the three components. If they were normal, they'd be flat on this middle line at 100%. So if we look at inventory being the purple line, you can see we have limited inventory, but we have limited number of offers. They're both about 65%. That gives us a days of unsold inventory right at the marketplace. Here's the recap again of all the different areas. That summarizes the Bay Area. I'm going to jump into now the Greater Bay Area, which includes the Central Valley, down here, the Central Coast, the North County, and also the cities, San Francisco and Marin. We're going to start off with the data, sort of the reverse order. So here are the actual numbers for each one of the counties for Silicon Valley, the 9 counties that make up the Bay Area, then the Bay Area totals. The reason this is in red is it didn't work and I had to calculate the number manually, and I want to make sure I get back to automatic for next week. Then you have the 2 counties that make up the Central Valley region and the 2 counties that make up the Central Coast. So here it is in Graphical. You can see the active inventory, the lack of inventory is a problem across the board. All the areas have very limited inventory compared to the past 10 years. Here's the number of offers. Offers are down as well across all the 5 regions. Days of unsold inventory. As a result, some of these areas are having a faster paced marketplace like the Central Coast. If you look at the blue line now versus where the blue line historically is, it's actually moving quicker. Why? I maintain that more people are willing to travel to Santa Cruz and Monterey and continue to work in the Bay Area. If you look at the orange, that's actually also a little faster, which is a little surprising because those are sort of the job centers. That's probably the one hiccup. Santa Clara County is really unchanged. Alameda County in the gray, or North Bay in the gray, has improved, and the yellow is Central Valley. Central Valley has probably improved the most. Look at where it is now compared to where it has been. You can see there's days unsold inventory is aggressive for all the areas. Most areas have improved more so than Silicon Valley. Silicon Valley is basically normal. 75th percentile time on the marketplace. Again, if you look at the components, most of them are lower now, so their homes are selling faster now than they were before. Santa Clara County, Silicon Valley is selling about the same speed as it normally does. This is the median days on market. I don't like it because it doesn't give you as much of an indication, but there it is for those that want it. Here's the sellers that are taking the largest price reductions. You can see that they're fairly typical. It's almost hard to read, but they're all on top of one another with sellers not taking very much price reductions. And that's the 10 percentile. This is the average reduction. So you can see that the Central Coast is taking the biggest price reductions, somewhere around 98 and a quarter. And Silicon Valley is taking the least at something like 99 and a quarter, but all within 1% of one another. Magnitude of overbidding. The biggest overbidding is happening in San Francisco and Marin, followed by Silicon Valley, followed by the North Bay, followed by the Central Valley, followed by the Central Coast. This is the overbid median, so half above and half below. So most of the counties are up here, somewhere around 2% above. You can see the Central Coast is down here at 100%. So sellers are getting exactly what they're asking. Smallest amount of overbidding. So this is basically the biggest price reduction. 7% is sort of the biggest in the Central Coast, or maybe that's 8%. The others are pretty much grouped at 5% as sort of the biggest reduction sellers are taking. Yes, there's 10% that are taking more. The biggest overcreases is San Francisco Marin at about 22% above, Silicon Valley at about 18% above. These three are pretty close together at about 6%. Frequency of overbidding, we go from 35% up to 65%, sort of the balanced market range, which stops off at 50. So these are sort of balanced. You have 2 areas being San Francisco and Marin and Silicon Valley that are basically in seller's marketplace based on overbidding. Here's the total appreciation. You can see that San Francisco and Marin, again, the job centers really appreciated significantly less than the other regions. And with that, we're back to the URL table, and I'm open for any questions. Not seeing any unmuted mics. Have a good week, everybody. Take care. Bye for now.